Good morning, everybody. It is 10 o'clock, and so I want to be very respectable of everybody's time. I am Jenna Minyard. I am the Chief Engagement Officer at the Montgomery Area Chamber of Commerce. We are so excited to have you join us today for our first ever virtual Financial Friday series. We have partnered with ASE locally in Montgomery, and we're just so excited to have Mike and Ed on the call with us today. And we're so excited that you took time out of your busy schedules to join us for this great session. Again, this is our very first one. This is a series of 4. And so October 2nd, today is the first one of the series. And we're going to get down into the nitty-gritty of the lending process. So thanks again for joining us. I see there's a lot of people on the call. It's a great day to be here. These work together. Programming events are just great for our small business community. And so we're just really anxious to get started, and we're really excited for you to be here. I'm going to go ahead and get these slides going. So really quick, before we get started, I just wanted to intro Mike and Ed really quick. Again, Mike Hart is the CEO at ASE, and then Ed McCarty is the COO at ASE. So they're going to provide us with some exceptional just learning today about the lending process and about for small business development. So we're just really excited to have them on the call, and I'm going to turn it over to them and let them get started.
So what we're going to cover today, and I'm going to cover the first 3 slides, and Ed McCurdy is going to jump in on the 4th, but we're going to talk about a business plan. So we'll start there. So as you're thinking about, and if you'll advance, please, if you're thinking about starting a business up, or if you've got an existing business and it's time to borrow some money in either case, then the business plan really is your opportunity to tell your story, to paint your picture to a lender. What you want to accomplish from this are a few things. You want to give a good description of your business and what your plans are, and you want to make sure that you're inspiring confidence. So it's an idea for you to go tell your story and inspire confidence with a potential lender. Where you can supply a competitive analysis, you need to do so. The business plan needs to be data driven, and it needs to be factual. And what we sometimes say in our world here is hope is not a strategy, nor is it a revenue producing asset. So in your business plan, while you want to list what your aspirations are, you want those to be supported by the fact that you've got data to show that you've done your investigation and that you can inspire confidence in the lender. Where you can include a pro forma, then you're going to want to do that as well. That can be a 1 year, a 2, a 3, a 5 year. Now, I would tell you there are a lot of resources available, but I would tell you where you want to use the information that's available. We live in an age where there's more information available than there's probably ever been in the past. So use that. One good resource as you're developing a business plan is to visit the SBA, the SBA Small Business Administration website, and they can help you understand what you might want to include in that plan. But what I would tell you, the 2 takeaways or 3 from this slide is it needs to be data driven. You need to include market analytics around your industry or your particular business, and you're going to want a pro forma in there as well. So if we could advance to the next slide, please. So on the next slide, we're going to talk about why you're actually borrowing. What has presented itself with your business that requires you to go out and seek capital. And we've got listed here 3 or 4 things that might be common reasons that you borrow. So if you think about the first one there, startup capital, I'm going to just tell you, for a financial institution, that's the one that we like to hear or that we like the least. And the reason why is that if you're coming to a lender and trying to borrow money to get in your business, then what we want to see is we want to see an injection of capital. We want to see some equity there. And you can do that a number of ways, and we'll talk about that throughout this process. But what we simply say is we want you to have some skin in the game, or we don't want to be the ones that assume all of the risk. So, some other reasons you may borrow that are pretty common, inventory. whatever you're selling, you might want to have a working line of credit, or you might want to have a lease or a term loan to help cover that inventory. I would tell you that if you are whoever you're buying that inventory from is a place that you're going to want to look as well. Do they offer terms for you? Can you, rather than utilizing a line or a loan, can you get terms? Can you get those terms based on net 30, net 60, net 90, meaning that you receive the inventory and then you've got some time to sell your inventory before the payment is due. Now, another way that might present itself to a financial institution, a bank, or a credit union is you might need a letter of credit. They may give you terms, but they may want to see that you're credit worthy, and they may want you to provide a letter of credit for them. So keep that in mind. Other things that we see commonly are equipment loans. And again, I would tell you that you can often find favorable terms from the manufacturer or the seller of the equipment. So look there. But if you go to a financial institution, you're going to want to be able to provide them with pricing on the equipment. You're going to want to be able to provide them with a legal description of the equipment. And ideally, that's going to be the collateral for your loan. And then the fourth thing that we've got under that bullet of why you're borrowing is common, and that's expansion. Are you looking to grow your business? You would have defined that in the business plan that you're presenting. You want to build confidence with the lender as to why expansion is going to be profitable. Where you can, you're going to want to be able to define the term that the length of time that it may take for the expansion to start giving you a profitable return. So, common collateral for an expansion loan might be the purchase of new real estate. It might be buying market share. It might be buying into a franchise or something like that. So the next bullet, if you will, there is choosing the right lending source. And I'll tell you, in my career, I have never seen more options available in the marketplace than there are now. So we're going to kind of break that down into two general categories: traditional financial institutions, and when I say that, typically I'm talking about a bank or a credit union, and non-traditional. But as we think about traditional, then what you might expect from a traditional lender are traditional loan products. So on the first one there, we've got conventional loans, lines, and leases. So if you think about a conventional loan, then it's usually a closed-end loan. You want to borrow X amount of money at a certain, probably fixed interest rate for so many months or years. If you think about a line, then where you see a traditional line of credit, and those can be used for many purposes, but that's an open-end loan. So you're borrowing, typically you would have a credit limit. I mean, if you think about your personal credit card, that is basically a line of credit. But a line of credit might be a guidance line for a specific business purpose, but it's going to be an open-ended loan. And as you draw money down from that, the line amount is going to decrease, your availability is going to decrease, and as you repay it, then the availability comes back. What I would tell you that a lender is going to look for is they're going to want to see that line flat. They're going to want to see that line at zero at some point over the course of the year. Typically where we see businesses use a line might be around inventory. It might be around some seasonality in their business where they have a quarter or a 3 or 4 month period where their business is really good and they go through a slow period, they lean on their line. And then when business comes back in the next season, the lenders like to see that line paid back down. And then the other one that is an opportunity for small businesses or businesses of all sizes actually are leases. And you can get those in a variety of ways, but if you've got an equipment need, for instance, that carries a fairly short lifespan, we see this with software, for instance, and things like that, or computer IT hardware, then that's a good opportunity to look for a lease. Banks do that. traditional financial institutions do that, and often the supplier of that equipment might offer that option as well. If you come down to the second point there, secured and unsecured, I think that's pretty straightforward. It simply means that if it is a loan secured with collateral, then you're pledging that collateral. And should you default on the loan, then that collateral would be in damage, or that collateral would be at risk. And unsecured means that you are pledging your personal guarantee, and you're signing for the loan, and you're responsible for the loan. Multiple collateral options. Again, in a traditional lending source, you'll find the options we've talked about. I also want to mention the Small Business Administration, the SBA loans. That's a good opportunity as well, particularly if you're looking for startup capital or you don't have maybe 3 years of business experience. Then I would tell you, you might want to do some research on SBA loans. Generally, what you get with an SBA loan is it's delivered through a traditional lender, but the SBA guarantees or underwrites a portion of that loan. Typically, depending on the loan type and amount, that's either 75 or 85% of the loan. And the reason that that's attractive to the financial institution is it lowers the risk they have in the case of default. So if you were borrowing money through an SBA loan, then the financial institution might have 75 or 85% of that loan amount guaranteed. And then, you know, the other thing that certainly that we want to mention is the idea of utilizing your own equity, your personal assets. And how we commonly see that done is through home equity. A lot of people have equity built up in their personal residence. Could be investment property as well, but you can cap into that equity and use that for funding for your business expenses, as well as other personal assets. You know, that could be any sort of liquidity you have in terms of a cash instrument, a CD, or something like that, a savings account. Now, I will tell you that sometimes people will come to us and want to borrow money against a retirement plan. Can't do that. Can't borrow against what, you know, we would call qualified assets. So your personal assets are a good source, but understand that you can't borrow against qualified retirement money. So Noah went through that sort of quickly. There'll be time for questions at the end, certainly, and we'll address that. But Ed, I would hand it over to you to finish out.
Great, thank you, Mike. And again, this is Ed McCurdy. I do want to say real quick, sort of as a disclaimer here, that that what we're talking to you about today, and when it comes to the lending process, is sort of general. Each lender, each financial institution that you talk to may vary a little bit about what they tell you, what their requirements are. But these are sort of general requirements that a lending institution may have. So we're gonna talk a little bit about what type of loan, and Mike talked a little bit about that. But you know, the type of loan is basically what do you need in your business, and you probably identified that in your business plan. Is it something to finance your receivables or your inventory? Is it or are you needing additional vehicles or equipment, or are you needing real estate? You know, you're needing to add on a building or purchase a building to operate a new business or an existing business out of. So we're going to talk about that a little bit. And then, you know, are you going to do the loan in a business name, or are you going to do it in your personal name, and what that might look like as well. So as far as types of loans, and again, Mike touched on some of these, but you know, the most simple type loan is an unsecured loan. That's with no collateral for the lender. And while we do unsecured loans, you know, those are, you know, would be sort of short, smaller type loans for a shorter duration. If you're needing something to finance your receivables and inventory, it's probably more like a line of credit. A line of credit is just a short-term loan. You set up a line and you draw on it to, sort of pay it back. I always sort of compare that to almost like your credit card. You have a limit on your credit card and you draw on it and then you pay it back down. Lines of credit, you pay interest on a monthly basis. We don't normally, when you get billed for that, you don't have a principal payment portion of it, so it's interest only, and then you just pay lump sums down on your line of credit as your receivables come in, as you're paid. So that's sort of a short-term line of credit that can be secured by various different ways. It could be secured by real estate. It could be secured by your inventory and receivables as well. A term loan, there's what we call sort of an intermediate or short-term loan, and that would be what you would use to purchase your equipment, vehicles, something like that. Those term loans normally run 3 to maybe 10 years, and as Mike said, most of the time those are a lot of times those may be fixed rate type loans. The other would be a long-term loan, a real estate type loan, and it would obviously be secured by the real estate itself. And generally those are 10+ year type loans, and you may see those. The rates may be fixed for 5 years, or some might be fixed for the entire duration of the real estate loan. So those are sort of the types of loans. Now, again, as I mentioned a while ago, we'll have to decide if you've got an organized business. You may want to put the loan in the business name. If you don't, then it'll probably be a loan will be in your personal name. So overall, lenders like to be well secured. Lenders like real estate, like to be secured by real estate, and that investment or that equity in real estate could come from a home or from an existing building that you have now. So with that, we're gonna flip over and we're gonna talk about documentation, and there are different ways of looking at documentation, and of course, the more the better, and I think you try to remember that, because the business plan is going to give us an idea of what you're wanting to do, but the documentation is going to back up what the business plan is telling us as well. So we're going to want a lot of information from you. From a personal standpoint, we're really going to look at probably a minimum of 2 years tax returns, and then a current personal financial statement. Financial statements no more than a statement that lists your assets and then the corresponding liabilities that go along with that. Each financial institution may have their own specific financial statement they want you to use, their own format, their own form. Some financial institutions, some lenders will accept financial statements from other lenders as well. But and then from a business perspective, we're going to want to have at least 2 year tax returns, a balance sheet, and a balance sheet is no more than a financial statement on the business. And we normally is, when I say a minimum of 2 years on personal and business, that'll really depend on, number one, how long the business has been in existence. Obviously, if it's a startup business, you're not going to have historical numbers on the business. You're going to have to be going from the pro forma that you put together in the business plan itself. So with the business, at least 2 year tax returns, a balance sheet, and a lot of businesses have what we call P&L, profit and loss statements, year to date. So if your year ends, say December 31st, but now it's maybe July or August of the year, then it's always very helpful to have a P&L, profit and loss statement, for each month up through, say, whatever the current month is. That's good for the lender. The lenders like to see that for a couple of reasons. It gives us the most current numbers on your business, and it also shows, it demonstrates to us that you are on top of your business. You're looking at it on a monthly basis as far as the profitability of that business. And if for some reason something's happening financially, you can adjust to that and react to it much quicker if you're looking at it on a monthly basis. And then obviously if we're doing it in the business name, we want organizational documents, articles of incorporation. We want your LLC agreements, operating agreements, bylaws, that kind of stuff. So again, we like to see a history of stable income, just obviously so we can secure the or ensure that repayment is made in a timely manner. So that's again, some of that depends on whether you're an existing business or a startup business as to what you have available and can supply to the lending institution. So let's flip the slide and let's go to credit worthiness and talk a little bit about the 5 C's. This is once we get everything put together and the entire credit package, as we call it, then we start looking at the 5 C's, and this is what helps us make our decision at the end of the day. First of all, we're gonna talk about we're gonna look at the character. The 5 real quickly are character, capacity, collateral, capital, and conditions. So character that's pretty simple. Who is it? What about the individual, the business reputation itself? One of the quick ways that we can look at character of the individual from a credit standpoint is by pulling a credit report. So, we're going to pull a credit report. We want to see what your credit score is, how you've handled your debts from a personal standpoint, making sure there's no kind of bankruptcies or collections out there. And because generally what you've done on your personal side, it's probably going to be pretty consistent with what you do on your business side. So if you've handled everything from a personal standpoint, your personal credit scores are good, then that's a positive aspect of somebody's character. Capacity is just the ability to repay. We talked about getting tax returns, looking at pro forma information. We want to get your income and to be able to look at historical numbers if possible, and compare that to the expenses that you will have, your payments that you will have once this loan is done, to make sure that you've got adequate income, you've got the capacity, the ability to make the payments. That's all we want when we make a loan is, we just want our money back, sort of one payment at a time. The third credit bullet point that we look at is collateral. So do you have equity? We're more comfortable from a lending perspective when we got adequate collateral outstanding there. Collateral, our primary source of repayment is from the cash flow, is from the earnings of the business, and to make the payments. Not only our payments, but all of your payments. The secondary source of repayment is always the collateral. We don't want to get to the point of having to rely on collateral or the secondary source of repayment, because that's generally not good for the borrower, and it's certainly not good for the lender either. So our primary focus is on the cash flow, but that will depend a lot, depend on how much money that we'll lend, based on what the collateral is worth and how much equity is outstanding. So the fourth bullet point there is capital, and that represents what somebody has equity that they have invested in this deal, and that goes back to whether we what the collateral looks like. It goes back to what kind of cash you're putting into it. And it also, capital also makes reference back to, how much cash you'll have on hand, or how much of a security net that you'll have once you get into the business here. So the last C here of credits is going to be conditions, and that's around the risk for the business, the industry, and the local and national economy. What might impact your business? We want to be able to, if there are things that, and in all cases, there are conditions that are going to impact your business from a positive standpoint, and obviously from a negative standpoint. But if it's from a negative standpoint, how do we mitigate those risks? We want to mitigate that. We want you to be able to mitigate that, whatever those risks may be, as much as possible. And you may be thinking a little bit about exactly what are you talking about risk in this local and national economy and stuff. But it would be sort of like in this pandemic that we're in right now, opening up a restaurant right in the middle. We know how a lot of restaurants have unfortunately struggled during this period of time, and that would be one of the things that would certainly be fall into that local and national economy and conditions that are going on right now. So that sort of wraps up what I have here. And Mike, I will turn it back over to you.
Thank you, Ed. Great job. Hope everyone's finding this information valuable. Looks like we've got a couple of questions that have been sent in. So Ed, why don't you and I discuss that? One of the questions was in regard to variable versus fixed rates. And what I would tell you is a lot of that is going to depend upon the kind of collateral you have and the kind of loan that you are requesting. And in some cases, you may have a choice. You may get an offer for a variable rate loan. It's common to see, for instance, a business real estate loan that might have a 15-year amortization and a 5-year maturity. The rate may be variable in the first 5 years. It might be based on prime rate plus a margin, or it might be fixed rate at 5, and then it turns at maturity would turn into a variable rate. And really what I would tell you is that you've got to weigh the risk. So obviously with a fixed rate loan, you may pay a little higher rate, but you don't have any risk exposure over the course of the loan. With a variable rate loan, it's just the exact opposite. You may get a little bit lower rate, but then you've got exposure as the loan matures or it runs to term. Now, having said that, I will tell you that we're living in unprecedented times in terms of rate environment. Rates are extremely low, and the Fed has repeatedly said that they don't have an anticipation of raising rates. Most recently at their Board of Governors meeting, I believe they said they had no expectation of raising rates possibly until into 2022. I can't recall in my lifetime ever hearing a statement like that from the Fed. So variable rate loans, very attractive right now. You run the risk in a rising rate environment, which we do not seem to be in, of having additional expenses over the course of the loan versus a fixed rate. Ed, would you add anything to that?
Yeah, just quickly, when you start talking about variable rates, floating rates, first of all, generally you're going to see those on a line of credit. Generally, any line of credit that you have will be a floating rate. And then once you get back into the term loans that I was talking about earlier, whether it's an equipment loan or whether it's a real estate loan, then you might see a fixed rate period of time, as Mike said, like on real estate, five years maybe fixed of the 10 years or the 15 years or the 20 years. So and when you go to be determining what that variable rate is, if you decide to go that route, make sure that you're aware of what the margin will be. Generally in today's world, we're variable rates are tied to the prime rate. Now, sometimes you see the LIBOR rate, but most of that is changing now and sort of phasing out. But generally, I'd say 99% of the time, you're going to see a floating rate or a variable rate tied to prime, and then there's a margin. So it may be prime plus. It could be prime flat. It could be prime. It could be prime plus 1, prime plus 2, prime plus 3, prime plus 4. All of that normally is determined based on the risk. So once analyzing it, that's when the lender decides what is the risk on this. Is it prime plus 1, or maybe if it's an additional type risk, carrying more risk, and it may be prime plus 2, prime plus 3. So that's a little bit about the floating side of it. But now, as Mike says, now rates are historically low right now. So my thought is as much as you can lock in right now in this low environment, low rate that we're in, low environment that we're in is better.
And Ed, you talk a little bit about risk, and remember the lender is going to look at risk in 2 or 3 ways. One, what is your actual credit risk? How good is your credit? How strong is your guarantee? Collateral can be another type of risk, as well as the industry you're in. Some industries are riskier than others from a lending perspective. Looks like we also had a question, kind of fits right into this. When is a good time to refinance? And I would tell you probably now. Now, there are 2 or 3 things you got to look at. We talked about the rate environment. Rates are great. Depending on an existing loan you have, a business loan particularly we're talking about here, then you need to understand in your loan what the loan contract that you're currently involved in, did it include a prepayment penalty? So sometimes it's common actually that if you're getting a term loan and you're getting a fixed rate, then there may be some portion of that loan that falls under a prepayment penalty, meaning that it may be you got to be 3 years in before you can refinance. It might be 5 years in. So you're going to want to look at that. But if you've had a loan for any period of time, the chances are the rates are lower. But you're going to have to look at, am I locked in for some part of that term based on a prepayment penalty? And then the second thing you're going to look hard at is what costs are going to be associated with refinancing. So if real estate, for instance, is the collateral, then there may be costs associated with that. You may have a new appraisal fee. If you had to have an environmental inspection or at the beginning of it, then you may have to pay for that again. If there are filing and recording charges, you're going to have to pay for that. If there are attorney fees, then you might be on the hook for that. So evaluate what are your closing costs going to be relative to the money you're going to save, and then be sure and check to see if there's a prepayment penalty that applies to your loan. And ask your lender you can ask your lender these questions, but also, ask them, does it make sense for me to refinance right now? And they can run terms for you and let you know the answer to those questions. Ed, did you want to add anything to that?
No, I don't think so, Mike. I think you covered that well. I know we had another question here. It looks like, how do you look at bankruptcies? And that's a difficult one, quite frankly. Because and there are different kinds of bankruptcies. There's Chapter 7, there's Chapter 11, there's Chapter 13. So you want to know background on that bankruptcy. You certainly want to know why bankruptcy was taken. Sometimes it's because somebody had a lot of medical bills, or had a bad accident or something like that impacted them, and they had to declare bankruptcy. And 2, how long ago was that bankruptcy been? And it will be on your credit report for, depending on what you want, 7 to 10 years. So that's one we have to look at real closely, because that ties back in, possibly to the character that we talked about earlier, and it's going to greatly impact your credit score from a personal standpoint. Obviously there are business bankruptcies as well. So, we just have to look at those bankruptcy situations, closely. It's obviously not a good thing. We don't like to see those, because generally during bankruptcies, somebody some lender has lost some money, and you know, we're obviously in the risk business, and if somebody else is losing money, then has lost money, then you know, there's some statistics out there as well that somebody that files bankruptcy one time, that there's and I forget exactly what it is, but it's like a 50% chance or so that they'll file bankruptcy again. So you know, it is, bankruptcies are a concern of ours, and it makes it a little bit more difficult. Mike, anything?
Yeah, you know, I would simply say that if you have a bankruptcy in your credit history, then it's going to become even more important through your business plan or through your conversations with a lender, a potential lender, that you highlight and describe what has changed, what circumstances have changed that mitigate that risk that came with the bankruptcy. So perhaps you're in a different industry, perhaps you've accumulated some liquidity, but what has changed in your financial situation that is a mitigant to that negative, the negative on your credit report, your bureau, around the bankruptcy. And, you know, you'll see occasionally where someone's got a bankruptcy, but yet they have went back and tried to fulfill the obligation. Ed mentioned typically there might be charge-offs, lender losses associated with that, but you'll also see where people have went back and said, yeah, I did charge this off, but I went back to try to make my lender whole. So anything that can mitigate the bankruptcy, the negative aspect of that, and then what has changed in your financial circumstances since the bankruptcy. So didn't see any other questions. Jenna, we will pitch it back to you. Appreciate everyone's attendance. Sorry for the shaky start. Hopefully we recovered from that. And I would also point out that we're glad to answer other questions. You know, I think we mentioned it, but just to be sure, there are really three things that you're going to want to have to establish as a business owner or operator. And you're going to want to develop a relationship with a financial institution. And, you know, we would love to have that opportunity, but you're going to want to develop a relationship with a financial institution, us or someone else. The second thing is you're going to want to develop a relationship with a good accountant that can help steer you through these operations as well. And the third simply is an attorney. So I would encourage you to look for those resources. We have our email addresses on screen here. If you've got additional questions about this, or if there's anything we can help you with, then please reach out to us. And Jenna, we will pitch it back to you.
Perfect. Thank you so much, Mike and Ed. And again, yes, sorry about the shaky start today. Technology, can't live with it or without it, right? I hope everybody on the call today learned something new or got some valuable information that they can take back and obviously use in their business. Again, that is why we started the Work Together Business Series, so that we could provide some dynamic content and programming that helps small businesses in Montgomery and helps the community. So thank you again, everybody, for taking the time out today to join us. This series will actually go through November 13th, so it's going to be every other week. You'll mark your calendars. October 16th, which is also a Friday, we'll be marketing your business. October 30th will be all about employees, and then on November 13th, we'll tackle taxes and investments. Again, we just appreciate everybody taking time out of their day-to-day to be with us. I will say that we will follow up with an email to all the participants. Tracy, Mike, and Ed, we're going to send out the PowerPoint that we used today so that people have it. And then if they have any questions, they can reach out directly to you, and we'll provide that contact information immediately. So thanks everybody again for this first ever virtual Financial Friday series. And we look forward to seeing you and everybody else on Friday, October 16th. So thank you so much.